You don't need to watch episodes of Shark Tank or spend hundreds of grands for costly degrees to learn the basics of business and finance. Business is something that everybody needs to learn, whatever career you take in your life. And accounting is the language of business, and finance is the medium of communication. Here is a simple 15-minute story-based format of a video that will help you gain all the knowledge you require to understand the fundamentals of business and financial statements. Assume that we are starting up a business, and we're going to set up a store, which is basically a coffee shop. And we are going to see the basics of business and financial statements as part of this presentation, and how this coffee shop generates revenue, and how does it balance sheet look like, how to raise capital, etc. That's what we're going to see here. So here is my coffee shop. There are three aspects we are going to look at this. First is how businesses generates revenues and profits, which means what does a business sell, or what does a business do as a sales of services or products, and how that translates to the profits, because we are all running business end of the day to generate profits and get the cash in our hand. Second aspect is most fundamental thing: how do businesses raise capital to start the business, right? Capital is the most essential thing when you start a business. Third aspect to it is business operations. How does a business operate when it starts scaling up, and how does it generate cash? So these are the three aspects you're going to see as a fundamental part of the business. And eventually, after this presentation, you will get to see further modules where deep dives happening across each of these aspects, each of the financial statement metrics, with real life example like Coke and Nike and Walmart. So let's see. So here is me, who's going to raise capital to fund my coffee shop setup. I have around $7,500 equity, which means that it's my idea and my proprietary store. So I'm going to raise equity. I'm going to approach an investor who is going to put 1/4 of the share, taking 1/4 of my stake in the coffee shop, and he is going to fund the capital with $2,500 minus 7,500 for the equity part, and that is 3/4 of the share of the capital I will hold, which is for my ownership part, which is 3/4, and the investor is putting 1/4, which is $2,500. Right now, I also need additional funding for running the operations and the working capital needs. So I'm going to approach a bank or a financial institutions, and I'm going to take out $2,000 debt at 10% interest rate, which is pretty phenomenally high, but I'm just assuming a hypothetical scenario. And so I'm raising the debt for 10%. Now, this is my capital structure. I have, as an owner, I have 7,500 worth ownership, equity, and the investor has put 1/4 share, that is $2,500 in cash, and I have raised debt for $2,000. So I'm good with the capital. I'm going to start the how I'm going to start the coffee shop, and we will see financial statement aspect, all these three, right? There are three fundamental statements: income statement, balance sheet, and cash flow statements. All these three are fundamental core concepts with respect to any company, and these three represent the language of the business or the accounting principles that it follows, right? So we will see how the coffee shop is set up and how it's generating profits, how they translate to these three fundamental statements, right? Now, here is the balance sheet of my coffee shop before starting, right? At the beginning, I have assets on the left side. So in a balance sheet, you have your assets on the left, you have liabilities, and you have your equity, which is nothing but the net worth of your coffee shop. In this case, asset is nothing but what you own as part of your coffee shop, and liability is what you owe to the debtors, to the creditors, and to the people whom you're raising money from, right? So the debt becomes your liability in this case, and equity is your net worth of the coffee shop after paying off your liability. So your assets minus liability is your net worth, or the equity part of your coffee shop. Now I'm going to show you, the cash raised is $4,500 because I have raised 2,000 from the bank, and I have 2,500 what an investor put as part of the equity. So I have around $4,500, and my goodwill, it is my idea, my proprietary ownership and equity ownership. So I've raised equity, so which is $7,500. So that's how it looks like, the balance sheet of my coffee shop, right? So that is your first financial statement, which is balance sheet. Now, further, drilling down, it is the assets, right? What you have in cash and what your equity portion is, 7,500. What your goodwill, it's part of your goodwill. So it's called goodwill because it is non-tangible asset that you have, which is yourself, right? Your equity. And you have your liability which you're raising for your franchise to run your operations, which is your debt. That is $2,000 which you have raised. That becomes your liability. And in this case, your equity net worth, you subtract, right? Assets is 12k minus your debt is 2k, which makes it 12 minus 2 is 10k. So your shareholders equity, which is nothing but your owner's equity, right? Owners, what is your ownership? So the owner's equity is your net worth of the coffee shop. That is $10,000. Now assume that per share value is $1. So that's your par value, and there that you put it in your balance sheet. Now the coffee shop is ready. Your balance sheet is good. Now you have your fixed asset that you need to set up, which is nothing but long-term assets or fixed assets. Here in this case is your store, right? You have to put up a store. It's a physical store, and you have to get your buy your inventory, create your inventory, buy raw materials, multiple other things, set up your design of the store, engage. Suppose you're buying this small store space in a mall. Let us assume that you're putting the store space in a mall, and you're buying it. Let's hypothetically think that the ownership is only just $2,000 for a small setup, and that's your fixed asset that can run for next 10 years. Assume that the store doesn't need much of renovation or additions to that one particular store next foreseeable future. So that's your fixed asset. Anything and everything related to the physical aspect of your store. And your inventory supplies raw materials like the coffee maker, the milk, the payment that you need to set up at a point of sale, your coffee beans, your cups, and sugar. All of that is your working capital, part of your working capital. So that is required to run your coffee shop day-to-day operation. So your inventory, supplies, raw materials, labor, all of that will fall. Suppose that is $1,500. So in the previous slide, you saw that your fixed asset is, for you are taking the fixed asset for $2,000 in the store space, and your running working capital is $1,500 for the one store that you have. So now this is how your structure looks like. You have cash of $1,000 because that is only left out. You moved $3,500 to your fixed asset, and your goodwill remains at $7,500. So net, it is still your $12,000, which is your complete asset, right? Now, the balance sheet after capex, how does it look like? Your asset is same, but it is redistributed because you've already spent your money in buying that fixed asset for $3,500. And you still left with cash of $1,000 to run for your future needs, and you have a goodwill of $7,500. And your liability is still same because you haven't taken additional liability, so it's debt of 2k. What is your equity net worth? Same thing, nothing has changed, right? Now the next aspect is income statement of your coffee shop. What all does it comprise? It's called profit and loss statement. In some places it's called earnings statement, income statement. There are different names for this. We call it income statement here. It has the revenues. It shows the revenues that you generate from your sales of coffee. It is a top line. Then you have your expenses, or cost of goods and services, COGS. And then you have in the bottom line, which is your profit or loss. So this is your high level structure of your income statement. So we have the income statement or profit and loss statement. Let us assume that I'm getting revenues of $4,000 in the first year, and the cost of goods and services is $1,000, with including inventory, raw materials. Depreciation is $200. Suppose my store is going to exist for it's in active life for the next 10 years. I have to depreciate that capital that I put every year, for the rest of the year, active life of the fixed asset that I'm putting in. So the concept is very simple. The store that I'm putting in this example, suppose the active life of the store is only say 10 years of all the machines with everything. That fixed asset is only 10 years. So the capital I put was 2000. So I depreciate it, over 10-year period. That is $200 per year. And labor expenses, with the people who can help me with the labor salaries and wages, commissions, everything, it's $2,000. So I get an earnings before interest and tax, which is EBIT, which is your operating earnings. After reducing from your revenue, 4,000 minus 1,000 minus 200 minus 2,000, you get $800. That's your operating earnings, or so-called EBIT. Now you reduce your interest portion, that is 10% for your debt that you took for $2,000. For simplification purpose, I put it as $200. That is 10% of 2,000. So you are paying interest of 200. And then you get your profit before tax, or somewhere it is called earnings before tax. And that is here subtracted $600. Now suppose you're paying tax of 15%. And corporate tax, I'm assuming, is 15% with a standardized swing. So it is, now 15% of 600, which is 90. So you subtract 90, you get $510. That is your profit after tax, so-called PAT, or earnings, and earnings that you are generating as part of your running your operations. So this is your profit and loss statement. I made it. Suppose you are assumed that you are making profits in the first year itself, which suppose you're lucky. But most often businesses do not generate profits from the beginning. They tend to make losses, and there will be a break-even point beyond which they kind of scale and they become profitable. But in this example, for practicality and making it easy, let's assume you're getting profits of $500, and so-called EPS, which is a very important factor, the earnings per share. The markets track earnings per share and its growth consistently year on year, quarter on quarter, and gives a lot of emphasis on earnings per share. And that's how market gyrates. The stock prices fall, and when earnings come, they can fall or they can go up. Now, earnings per share is nothing but your total earnings. In this case, is $510 divided over total outstanding shares, 10,000 shares in this example. So I have 0.05 cents that I'm generating every year, right? Now, that is a simplified profit and loss statement, how you look at a business angle, right? And then you look at growth, which is a very critical aspect of stock market for your companies, right? You are investing in a company, whether an entrepreneur or an investor, you are investing in a company for its future earnings potential. Past is done, nothing can change. What you're investing is for the future growth or future earnings potential or future cash flows. The valuation of the company is done by the market considering the future potential of cash flows, and it is discounted to the present value. We will see to that, when we cover valuation, but understand that at this stage, to start with, when you think from an entrepreneur mindset, the growth aspects of a company is the most important aspect, one of the most critical aspect with which the market values the company, with whether it gives a premium or a discount at every point of time, is because of the factors that is leading to the growth of the company, right? So in this example, suppose I'm having a good growth, I'm having good customers, I'm growing well, I'm setting up 5 coffee shops, similar coffee shops over the next 3 years. So I am partially successful here, and I'm getting a good revenue, and I'm growing like say 15% year on year. Revenue is growing from $4,000 in year 1, year 2 it is say $4,600, year 3 it is $5,300 approximately, right? And I'm also seeing that the cost of goods and services is also increasing commensurately, and the wages and the labors are also increasing because I need more employees with more stores, and depreciation because I'm increasing my capital structure. I'm putting more capex out there so my depreciation also increases accordingly for the number of stores. End of the day, my operating earnings are increasing at 25% in this example. So I'm getting, from $800, it's going up to $1,190. Interest is remaining same because I'm not taking debt here. I'm staying with the initial debt. I'm funding the future, growth with my internal accruals on the cash flows. So my interest remains same. It's $200 flat. Pre-tax earnings, before tax earnings is 600, 800, 990. It is also increasing. Tax is 15%, remains same, but it increases as your income in proportion to your operating earnings. And then you're getting your profit after tax, that is your net earnings. $500 you started the first year, you're having tremendous growth. You're growing it almost at 25% plus. So you're growing up to $850 approximately in the by year 3. So this is a snapshot view of how your income statement looks after you grow your stores. And so you have a successful business in your hand. And this is how your balance sheet changes. Its balance sheet is at a point of time. It is not the same thing for the rest of the 3 years. Your balance sheet also increases, it grows, your capital structure changes, your fixed asset gets bigger and bigger as you grow up, grow your assets, and your income statement also similar, right? It also changes every year. It becomes larger if you're having a successful business. In some businesses, you might have losses. The losses tend to be higher in the initial stages. Sometimes it goes down as you scale, and some at break-even point, you become profitable and you're having cash flows, positive cash flow, or free cash flows from the business. Only thing that you need to take away here is the profit is not same as the cash flow. I have not covered a cash flow statement here, but I've covered balance sheet and income statement. But the idea you need to understand is your cash flow looks completely different from your profit and loss statement. The reason is that cash flow statement is nothing but your net cash outflow and cash inflow, which may not be what you're seeing here. For example, your depreciation is a hypothetical depreciation over the 10 years. It is not the real cash outflow. And real cash outflow could be something not accounted here, right? So you need to factor in the real cash outflow and cash inflow for arriving at a cash flow statement. This is the basics of how to look at setting up a business, how running a business, growth aspects, how simplified P&L or a income statement looks, how a simplified balance sheet looks like for a listed company or even unlisted company, right? So the key takeaway is start with the business aspects.